Good afternoon. Welcome, and thank you for joining us for the fourth session in our 2026 webinar series at Hope Community Capital. Today's session, New Markets Tax Credits 101 for Community Facilities, is designed to educate on the fundamentals of NMTCs with a large focus on what community facility sponsors really need to know. Our experts will talk through attracting allocation, avoiding common pitfalls, building the right team, and getting to closing. I am Jana Woodhouse, Marketing Consultant for HCC. I am here to help support today's session. If you have questions during the webinar, please put those in the Q&A box. We will take questions at the end. The webinar will be recorded and will be emailed out to you about an hour after we are done today. You can also find this recording and other educational resources on our website, hopecommunitycapital.com. Now let me introduce you to today's co-presenters. Sierra Johnson is the Vice President of NMTC Practice at Hope Community Capital. She leads the firm's national work in new markets tax credits, Qualicby Consulting, CDE advisory services, and complex community finance strategy. Sierra brings deep expertise working with community-focused organizations to design and document capital strategies that blend grants, public funding, and private investment to drive equitable access and long-term sustainability. With over 15 years of experience across academic, nonprofit, and government sectors, Sierra is especially skilled at translating complex financing tools into accessible, mission-aligned solutions. She brings a rigorous approach to community impact analysis, funding pipeline development, program compliance, and post-award implementation support. She is joined by our second presenter, Nicolo Pinoli. Nicolo is a partner of Novogradac. He works out of the Portland, Oregon office where he specializes in affordable housing and community development, including the Low-Income Housing Tax Credit, or LIHTC, NMTC, Historic Rehabilitation Tax Credit, and the Opportunity Zones Incentive. He has extensive experience in a wide range of services, including financial statement audits, tax return preparation, writing NMTC and LIHTC applications, LIHTC, NMTC, Opportunity Zones Incentives, and Historic Rehabilitation Tax Credit transaction underwriting, consulting on LIHTC, NMTC, OZ, and HTC transaction structuring, and LIHTC, NMTC, and OZ compliance. Nicolo is a frequent speaker at industry conferences and delivers several webinars every year. He has published many articles on various technical issues confronting the affordable housing and community development industries and serves as a technical editor of the Low-Income Housing Tax Credit Handbook, the Novogradac LIHTC Year 15 Handbook, and Novogradac's Tax Reform Resource Guide. He is licensed in California, Oregon, and Washington as a certified public accountant. Sierra and Nicolo, I will turn it over to you. There we go.
We couldn't figure out how to enter.
Welcome. I will turn it over to you.
Thank you. I'm gonna start sharing here.
All right, let's get the party started and learn a little bit about new markets tax credits. I'm going to give us a brief background, and then Sierra is going to get into a lot of the meat and the fun elements of the new markets tax credit. And big picture, the program it exists to provide a tax incentive for private investment into economic development projects and businesses located in low-income communities. So these communities that have been historically underloved, have not received lots of economic investment, in many cases have a disproportionate share of poverty and low area median income. Those are the areas where the government is trying to incentivize private investment to flow into those areas to help kickstart the economy. The program is overseen by our friends at Treasury and is administered by a specific subset of Treasury called the CDFI Fund. And a lot of this happens behind the curtain, and you may not really need to know it, but since inquiring minds do need to know, the tax credits themselves are actually allocated by the CDFI Fund to community development entities, what we call CDEs, under a very competitive allocation process. In fact, we expect the next round of applications will probably kick off in the next month or so, we hope. And generally speaking, there tend to be about 200 applicants in any given round who are looking for allocations. In the most recent round, I think we had 142 winners. The credits themselves, while you're not going to get those, you will get the financing, which is really the result of monetizing the tax credits. The financing then can be used to finance operating businesses and real estate projects, whether owned by taxable or tax exempt entities. And I'm guessing that includes most everyone on the call here today. So what is a low-income community? Where are these areas where we're looking to invest? And part of the fun is that there is a minimum statutory requirement, which you see here on the screen, that poverty exceeds 20% or that median income is at 80% or less. And as you can see, we've also got our mapping tool pulled up. In fact, you can see a link to it in the lower left of your screen there. And this particular mapping tool, if you look at the map, you see there is a rainbow of colors, not just because we're celebrating Pride Month this month, but also because within New Markets land, there's lots of different ways of identifying distress and different flavors of distress, which Sierra is going to get to, about how you make your project that much more attractive to a potential investor by going into a potential CDE by going above and beyond the bare minimum levels of distress required under the statute. So how does the tax credit actually work? There's sort of a left side of our slide here and a right side of our slide. I mentioned we've got CDEs who submit an application to the CDFI fund for allocation authority. And in fact, if they win an award, they then sign an allocation agreement with the CDFI fund that governs how they end up deploying that allocation. Your role as project owners or prospective project owners, of course, is then to approach those CDEs who have allocation and get them to bring allocation to your deal. All the action around a CDE applying, it is a lot of fun, tremendous amount of work. And really, the only reason why you need any familiarity with that process is more about because that application process ends up driving what matters to CDEs in terms of the types of projects that matter to them, in terms of where they want their projects to be located and some of the features for those projects. So as a result, while the application is its own incredible bit of fun, for most of you, you don't really have to be that knowledgeable about it, but do know that in any given year, there is nationwide, there's $5 billion of allocation available, which sounds like a lot. And in theory, it is a lot, except that there are many more deals that are seeking that allocation. If I had to guess, there's probably 50, 100 billion dollars worth of deals that are out there that would love to get a piece of that allocation. And for that matter, when we talk about allocation, as you translate the allocation to actual credits, it's a much smaller number because in new markets, the allocation is the starting point, but to actually get to the credits, it's a 39% credit calculated as a percentage of that allocation. And so that $5 billion in allocation really only generates slightly under $2 billion in tax credits, 1.95 billion, which still seems like, I mean, anything with a B sounds like it must be a lot of money. But once you start finding deals and doing deals, you find that, guess what? It doesn't go nearly as far as we'd like it to, which is another way of saying it is a scarce resource. And that's why you're here today, to figure out, how do I make my deal attractive? And Sierra is really going to share some of the secret sauce with that. On the right side, you hopefully saw that there was a bit of the beginnings of a model, but this is so oversimplified, we might as well get into the next slide or two, which then sort of really shows what the model is all about. But in brief, an investor makes an investment in a CDE, and a CDE then deploys those dollars down to what we call the Qualic B. Here we have so many acronyms, you're going to get lost in the acronyms, but the Qualic B is the business that's in the low-income community. That's what Qualic B stands for, Qualified Active Low-Income Community Business. And it actually owns, the business owns the real estate, owns the assets that we're financing with our new markets. All right, let's move on. So in many cases, the tax credit investor, they really just want to limit their risk. And so as a result, they're not actually providing the full, all of the dollars needed to make the new markets transaction work. They're really buying a tax credit equity strip. And so as the math shows here, they really end up providing around, on a gross basis, before we net out for fees, about 31 cents on the dollar. So if you, in a minute, we're going to get to an example with a $10 million deal. And on a $10 million deal, they're only providing about $3.1 million in actual tax credit equity based on 80-cent pricing. And 80 cents these days is pretty close to the top of the market, I would say. The range is probably 75 to 80 cents on most deals today, and it'll change tomorrow. It was different yesterday. Every day it moves a little bit, and every deal is a little unique in terms of the pricing you get. But what that means is if the tax credit equity on a gross basis is only providing 31 cents, you need other sources such as grants or loans or from your own little piggy bank and capital campaigns and all the bake sales you can come up with. You get to find that other 69% of the capital stack. And how we marry these sources together is what we call the leverage model. In fact, that's what our next slide shows is we take the tax credit and investor equity from the upper left-hand corner, and that equity flows into an investment fund. That's an SPE, single member LLC owned by our tax credit investor. And we mix it with debt from our leverage lender. As I mentioned before, this debt really could come from lots of different sources, grants, capital campaigns, et cetera, et cetera, et cetera. Lots of other debt sources potentially could get mixed together to make this leverage loan. Those two sources, when you add them up, that tax credit equity, in this case of about 31%, leverage debt of about 69%, you add them up, it gets you to your total investment that's used to make that qualified equity investment. And unlike a lot of other programs, the qualified equity investment is actually what generates the credits. It's not what happens down at your business level, but it's that initial investment that actually is used to generate the credits, which is somewhat exciting because as a result, we don't have quote unquote qualifying costs where the government tells us this is in and this is out. If you've worked on renewable energy or low-income housing or historic rehab, we have lots of rules about what's in and what's out for calculating your credits. But in new markets, the credits are based on this qualified equity investment. So I think in the next slide, we're going to see the full structure put together. You notice the top half here is really a repeat of what we just looked at. And now we've sort of got the bottom half, our sub CDE, when it receives that $10 million qualified equity investment, makes loans. In this case, we're showing 2 loans to our Qualic B. It's also paying some fees, a nice 5% upfront fee, which is pretty typical. I'd say that's middle of the road average upfront fees. And when you sort of start looking at the math, you see that A note matches up with the tax credit, the leverage loan in the upper right-hand corner, those sort of trace. And that B note really represents the net equity, although we're still going to net it a little bit more with some fees and expenses, the net equity from doing our new markets deal. And our Qualic B now has $9.5 million that it can use to go and do the project. And if you're doing a little math at home, a big part of the magic here is I bring $6.9 million in debt in the upper right. And when I close the deal, out pops $9.5 million into a construction disbursement account that then I can use to go and do my deal. So this helps to close gaps. And we're really looking to close a gap if maybe my capital campaign or debt sources or grant funding can't cover the full $9.5 million that I need to do my project. So let's move on. And here's a quick calculation of exactly what my net benefit is. And to keep it simple, we're starting with $10 million again. And just a second ago, I said my benefit was 2.6 million, except that was before some other fees and stuff. So you notice I start with 10 million. My tax credits are based on 39% of the 10 million. My tax credit equity investor doesn't pay $1. Part of that's because the credit's a taxable credit. Another part is because the credit's claimed over 6 years and a day. Sometimes we call it 7 years. And time value of money means that $1 6 years from now is not worth $1 today, which is why they're paying less than $1 for those credits. So Already, our gross tax credit equity is just 3.1 million and change. Then we get to pay some fees. And my CDE is going to charge an upfront fee. We showed that on the last slide of $500,000, pretty typical. And then they have ongoing fees, which they want you to reserve upfront. And you probably want to reserve them too, because that way you don't have to come out of pocket on an ongoing basis. The money's already set aside. It's there. It's ready to pay for those fees. And 400 grand is a pretty typical dollar amount for CDE fee reserves to pay for ongoing fees and expenses. And the last thing you get to pay, since you always need at least one more thing, is your professional fees. The attorneys, way too many attorneys, an accountant like me, as well as your consultant like Sierra, we all get paid out of this bucket. Sierra and I take a very small slice of that 300 grand. Most of it goes to the attorneys because of course it does. And that's how we get paid out of the deal. And you notice by the time we're done, we started out with 10 million, very quickly went to 3.1. By the time we get done netting out fees and expenses, we're down to $1.9 million. On a good day, it might be 2 million. On a bad day, it might be $1.8 million. And really what ends up driving the difference between $1.8 million at 18%, or say 2 million at 20%, or maybe even on a good day, really good day, you might get to 2.1 million, is your ability to push on some of these elements. So for example, 80-cent tax credit price. I think my personal best was 92 cents on the best deal that got the best pricing I've ever done. If you can get higher pricing, that's going to generate additional net benefit. The CDE fees often aren't super negotiable, but to the extent that you can find a CDE that has lower fees, bully for you, and that means more net benefit for you and your project. And then finally, certainly you have professional fees and the opportunity to negotiate with the professionals. But more than anything, I'd say closing quickly and with a relatively simple structure is what's going to help to manage those professional fees and help to drive up that net benefit to your organization. But typically, I quote to my clients, 18 to 20% is a very typical net benefit depending on these factors for your specific deal. All right, Sierra, anything you wanted to add while we're talking about that element? And because I know that's something you love to get into, is that net benefit.
No, I think you covered most of it, and we'll talk about it a little bit more, Nicolo. But I think the most salient point that we're trying to drive home is the more prepared that you can be going into closing your transaction, the quicker it'll be, and also the more cost efficient it will be. And so, you know, you do get a 18 to 20% net benefit, but money isn't free no matter how you slice it. And being an engaged participant in a new markets transaction alongside your team is really what helps push that number up, I would say.
Great points. Thank you for sharing those, Sierra. All right, let's move on. I think there's one last slide here. Why did I hear this was like a grant? And you notice earlier on when we were looking at the structure, we talked about the dollars that flowed down to our project, to our quality. Those came in as loans. Those are debt. And yet somewhere, sometime you were at a cocktail party and somebody told you about their new markets deal and they said, oh, it's just like a grant and you get free money, which is shorthand, because the new markets is fundamentally a debt program. In fact, those loans have to come in as loans. If they came in as grants, it would not qualify for new markets. And therefore, because it's debt, it requires debt service. There's compliance requirements. And it's only after you get to the end of 7 years that really that B note, that net subsidy, ends up then converting to equity or being forgiven through the exit process on new markets. But certainly in the interim, it's loans. And for that matter, when you prepare your financial statements for your Quali B, which in some cases may get consolidated up to a larger parent organization, like if you're a nonprofit or even if you're a for-profit with subsidiaries, you end up potentially consolidating those subsidiaries. And therefore, what ends up being debt for new markets ends up also showing on your financial statements as debt. And I think that's an important distinction to make sure everyone understands is while this program, well, this deal that you close creates incredible benefits for your organization that will last for years. At the same time, it shows up on your financials as debt, which scares a lot of people. And I think is part of the fun of understanding new markets and being prepared for it and ready both for yourself, your organization, your board, your contributors, for them to understand, especially if you're a nonprofit, to understand that it'll end up being papered as debt and show up on your financial statements as debt rather than showing up as a grant that hits your bottom line immediately. But it will be income when you do get to the end of year 7 and you unwind. So good news, it eventually is. There's just a delay in the interim and it shows up as debt in the meantime.
Thanks,
On to you,
Nicolo.
Sierra.
So, do you have a project? I imagine that most of you do, or you have a project that you're thinking about, and that's why you've joined us today. So the first thing that I typically kind of go through when I have someone call me up or email and say, we're looking for new markets. Can you help us get new markets? Is just kind of a preliminary test fit. First and foremost, is this located in a highly distressed census tract? Nicolo brought up his rainbow map there. If it's not located in a census tract that qualifies, it's probably not a good fit. Is there community impact? Again, we talked a little bit about the application that the CDE has with the CDFI fund, the Department of Treasury. They are promising to the federal government that they will make community impact in the form of jobs or healthcare impacts or childcare seats. And so when they're looking at, their pipeline of projects, they want to understand what the impact is to the community. The but-for test. Do you have the money to build the building that you need to further your mission? If you don't, this might be a good fit for you. If you're fully sourced already, this is a lot of work. Maybe new markets is not right for you. Again, the deal size, ideally 5 million plus, and really you have to be a very, very simple structure for it to be 5 million. I would say more often than not, we're looking at 8 million. And the reason being, there are a lot of fees coming out. There are professional fees that come out. It doesn't really matter the size of the project. And so that just continues to erode that net benefit. And you don't necessarily want to go through this whole process and end up having to owe more than you'll end up receiving as net equity to the project. Is this program a good fit for your organization's strategic trajectory? Do you need to grow your real estate to further your mission? Do you need to expand your building? Do you need to renovate your building? Will you be able to do the activities that you are planning to do in the next 7 years without a new real estate asset? If so, new markets might be a good fit for you. Does the project timing fit with the new markets timing? I would like to say that we know exactly when awards come out every year and, when CDEs want to deploy. Unfortunately, I can't say that. So, engaging early and often and providing ongoing updates and demonstrating that, you're working towards a successful new markets transaction close. That's going to be kind of your best approach in terms of project timing. And then when we're talking about actually closing on a deal, that 69% that you need to provide for that leverage loan, is it committed? Do you have reimbursable grants? How are you going to monetize those reimbursable grants so that you can actually make your loan? How's your capital campaign going? Do you have all approvals from your municipalities, from your board? There are a lot of different stakeholders in a real estate transaction, both internal and external, and you want to make sure that you have all of those ducks in a row before you close a transaction, because otherwise you'll just be going from, an 8 to 12 week closing into, heaven forbid, a 9-month closing. So yeah, again, site control, environmental. Did you do an environmental site assessment? Is there a old gas storage tank underground? Do you have a plan to remove that gas storage tank? Have you engaged with a general contractor and architect yet and really, done a competitive RFP process? Do you understand your construction pricing? Is it a guaranteed maximum price or a fixed sum contract? Once you are in your building, can you operate your building? So do you understand what your revenues are going to be once you've doubled the square footage of your facility, or you have a brand new facility? You really want to understand how you're going to continue to be a going concern. Again, is your financing committed? Do you have signed grant agreements? Do you have high quality pledges? Does your board agree with the approach to pursue new markets tax credits? And then do you have someone assigned internally to kind of shepherd this project? Having consultants like Hope Community Capital and accountants like Novogradac are really helpful, but it's also very important that you have someone really assigned to this transaction process and the real estate process so that they're able to liaise between all of your partners and really keep the project moving forward in a way that is responsive to all of these different stakeholders. So we talked about a CDE several times here, but I think what I hear most often is, I want new markets. Can you get them for me? Or, Nicolo will get an email and say, I want new markets tax credits. Please help me figure out how to put those, how to apply for those. And what you're really looking for is you're looking for a community development entity willing to allocate their new market tax credit authority to your project. And so these are the entities that are really deciding where that $5 billion in allocation is going to go amongst the 100 to 200 to 300 billion dollars worth of projects that are happening in any year. So what they are actually underwriting are the community impact, who benefits. It's important that it's in a low-income census tract, but it's also important that it benefits folks in the low-income community. So are the jobs accessible to individuals that maybe just have a high school diploma or, historically have had a hard time getting a job? Is it creating childcare for working folks who can't afford really expensive childcare or the existing childcare options out there? Is it increasing high quality education for students in the low income community? Is it creating jobs in an area that doesn't offer a lot of employment opportunities? So these are the things that CDEs are looking for, and it's what they're promising to the federal government that they'll be creating as a result of their investment. Readiness, we talked about all this already, but they are not going to commit until everything else is lined up. So they are going to ask about the environmental. They're going to ask about all of your other sources of financing. They're going to ask about the internal approvals. And they will not commit to you until, they see that you are either wrapped up with all of those diligence items or that you have a path to getting to those places by the time that you close. And then again, the execution capability. Can the sponsor actually deliver? So that's part of that operating pro forma. Can you operate this building once it's built? Do you have the staff? Do you have the capacity to hire the folks that you need to work at your facility? Do you have the resources available to you to actually create that community impact? Without being able to reasonably demonstrate those pieces, you'll be passed over by a CDE. for someone that, provides a little bit more certainty on the readiness, financing, and execution capability.
Sierra, I'll just jump in and make one observation. These are amazing data points that you should all be very focused on. I would really boil it down to maybe one simple concept, which is you really have to have a business deal first, and then we use new markets for gap financing. If you say, I'm going to use new markets and I'm going to go and figure out how to use it and find something to use it on, I think you'll find that's a fail. But if you have a well-cooked business that's well considered, you've worked through all the details of figuring out how you're going to make this thing work, and then we add new markets, that deal is going to work much better than trying to reverse engineer.
Absolutely. So once you have that high quality business plan, how are you going to go get these new markets? How are you going to attract a CDE? So we've said it once, we've said it twice. This program is highly competitive. So just because you qualify does not mean that you are an attractive entity to these CDEs. So again, they're looking for real measurable benefits to low-income communities, manufacturing, healthcare, education, housing. Those are really kind of the big four that CDEs are looking at right now. And those are the ones that are going to generate the most interest from CDEs and from their tax credit investors. And again, having all of our sources of the leverage loan must be fully committed. When we're talking about those impacts, again, education, childcare, food access in some cases, the administrations do have some, I would say, influence over the CDFI fund and Treasury on the types of CDEs that, will win year over year. And so, the priorities of the current administration is really looking at rural health. They are looking at community resilience, rural access, tribal communities, rural manufacturing. So you are going to see those entities being a little bit more, those CDEs being a little bit more competitive when they go and apply. The other kind of, I would say, a little bit more secondary, more recently are going to be the construction jobs. So are you working with minority-owned, women-owned, disability-owned businesses as part of your construction team? Are you creating environmentally sustainable outcomes? That can also help in your business plan, right? It's making your facility a little bit more sustainable and potentially cheaper to operate in years to come when we're seeing energy prices go up. And then, creating and retaining quality, accessible jobs. Those are going to be really important key criteria that CDEs are looking at. And then again, demonstrating that financing gap. So when we talk about high distress, I'm pulling or zooming in a little bit more on that fancy map here. So every year, these CDEs are committing to areas that are considered more severely distressed or in recent years, deeply distressed. And so if your facility is going to be located in a purple area, well, you just got more attractive to CDEs because they have committed to 20 to 30% of their allocation will be in a deeply distressed census tract. So it is, other than being able to pick your site, that's a pretty arbitrary, I would say, ability to be more competitive, but it is what it is. And you can't say, oh, I'm just across the street from the purple zone. You're either in it or you're out. And then the severe distress, I would say, is really kind of the threshold at which the community development entities are looking at in terms of deploying their tax credits. So, being in an eligible census tract in this yellow box, Yes, that means that you could potentially qualify for, or you do qualify for new markets tax credits, but from an ability to be competitive against other projects is probably quite low. There's, always exceptions to that rule, but it is worth considering as you're going through this process.
Sierra, maybe I'll just make a couple of observations. One
Yeah.
is if you're on the wrong side of the street, the only thing you can do is move your project to the other side of the street. You
Yep.
can wait for the new maps to come out. We do have new maps probably coming out in the next few months, and there'll be a window, probably about a year, where you can either use the old maps or the new maps. I will say, even though it sounds more distress, severe distress is actually less distress than deep distress. So keep that in mind. You want to be purple. Red is sort of the bare minimum. If you're this, what is this, taupe, tan color, that's nice, but probably isn't enough to actually be attractive to a CDE. And if you're in the gray, then you're host. And there is something called targeted populations that we can use to try to make your deal work. That's not a beginner concept, so we're not going to go there. But if you hear somebody say, well, I was actually not in a qualifying zone and I did it, that's how. And someday when we talk about your deal, we can always talk about that detail.
Yep, definitely. It's not a beginner concept for CDEs either, so they often groan when they hear that. So a couple things that I hear and some of my colleagues have heard over the years is, if I had known then what I know now. Free land isn't always free. So your municipality may saying, "Oh yeah, we'll give you this parcel for $1. We would love for you to redevelop it, but we're giving it to you as is." And then it turns out there was a dry cleaner there for 100 years, and there's a railroad next door, and there's 50 easements, and so you may end up spending several $100,000 cleaning up those environmental issues or, satisfying any easement requirements. So really understanding any sort of conditions of land prior to accepting that free land is critical, or cheap land. Um, Prior costs can become expensive. We're not going to go into this too much, but if you've spent any money going into a transaction, those can be attributed to your leverage loan, but it's really important that you're accounting for those in a very precise way before you go into the transaction. So you have your invoice, you have your proof of payment, and you have this all in a nice file and not in a shoebox in your attic. I have seen the shoebox in an attic situation, and that is uh, that's a hair puller for sure. Permitting matters. Timing kills deals. So making sure that you are working with your permitting entities early and often, and that you're communicating with your municipalities so that you have permits in hand and ready to go when you're closing. Because if you're submitting for permits right as you start a deal, and the city comes back and they say that they want you to change something in your construction or your plans and specs, or it's going to maybe take them 6 months to issue permits. You're going to be waiting quite a long time to close your transaction. Again, that fundraising timing matters. So you need to have all of your leverage raised when you close your transaction. And then the team selection matters. So the wrong advisors can increase cost. Working with a general contractor that understands the draw process, perhaps has some experience working with public financing tools that can really help make the deal go a lot smoother than working with an architect or a general contractor that might be push back on things. 5 biggest deal killers that we see. Again, that incomplete fundraising. If you don't have all of your sources to build the building, you'll never close your transaction. Weak operating projections. This goes back to Nicolo's business plan comment. If you don't have a good plan for your business, it is going to be very challenging to attract allocation, or frankly, even if you do attract allocation, close on a transaction. Again, those prior cost documentation problems, that just creates a lot of strife and time. Project not actually being ready. And then, you don't have your construction contracts. You don't have an environmental site assessment. Maybe you don't have your permits. Your board is not on board. So I have been on a deal where they had a leadership transition and the incoming leader did not understand the transaction. And 2 weeks before closing, they said, nope, we're not going to do this. So, really having a full understanding, not just with, one individual working on staff, but, the whole leadership, really understanding what the transaction is and what you're signing up for is really important. And then again, insufficient internal staff capacity. And again, that's just having a strong business plan again. So how do you get these things done in a timely and cost-efficient manner? Having a good team behind you. So you're the consultant, an attorney that's familiar with new markets tax credits. There are a lot of groups out there that say, oh yeah, I was on a deal once 9 years ago. It's probably not going to be the best attorney for you. You really shouldn't be paying for their learning curve. So working with someone that has some experience behind them and understands some of these concepts. Having a strong accounting team behind you, a good owner's rep. Many times this is going to be the only time that you're engaging in a large real estate transaction and building a new building. So having someone who understands the process, that can work with your general contractor, your architect, your other professional teams, and really translate some of those concepts and advocate on your behalf is going to be really helpful. Again, your architect, your lenders, the composition and the character of the money that you're bringing in to fund that leverage loan, it matters, and it can also cost you or help you down the road. And having engaged board members. So let's say you're like, I've checked all of those boxes, Sierra, and I am ready to go. And I even have a CDE interested. What does closing actually look like when we get to the day of closing? There's going to be many wires going through. So, you're going to have lots of money moving around, millions of dollars through multiple entities. If you have a simple transaction with one CDE, you're dealing with 5 or 6 entities. If you have multiple CDEs, you could have upwards of 10 to even, I'm on a deal with 9 CDEs. So you've got 9 lenders plus potentially some source lenders. And you're balancing all of their interests. And multiple bank accounts. You'll be dealing with board approvals. Don't let your signatory go on vacation a week before you close, because that will shift your closing date as well. And then you'll have lots of legal documentation. You'll end up with a binder of about 170 legal documents at the end of it. So again, that kind of goes back to our team as a force multiplier, having a consultant, an attorney, an owner's rep that really understands these documents and what you need to pay attention to will really help as you go into this closing process. And then life after closing. What does that look like? So you've gone through the closing process, all the wires have moved, your construction escrow account is funded, and you're ready to build your building. What does the 7 years look like afterwards? It's actually relatively calm throughout the 7-year compliance period. You are going to be paying quarterly debt service on those new markets loans. You're likely going to be paying rent to your Qualic B entity to make those debt service payments. So you have some money moving around. There'll be some annual compliance, which looks like submitting quarterly unaudited financials, annual financial statements that are audited, your annual tax returns. And then there will be an annual community benefits report that you'll be sending to your CDEs. So you've promised up front that you'll be building a school and creating 500 new quality education or childcare seats. Now you got to report it on it for the next 7 years. Who you hired, what kind of benefits you provided to those employees, how many students are at your school, how many of those students qualify for free and reduced price lunch. It tends not to be super heavy lift, but it is important that you're on time with that reporting. And then, very importantly, succession planning. What happens if your CEO leaves 3 years into your 7-year compliance period? Making sure they understand, what this transaction is, why do you have these huge liabilities on your books, and what's going to happen after 7 years after you close. Same goes for your board. Many boards, folks might leave after 3 or 4 years, and, being able to explain to them what the heck this is important.
Sierra, I'd just add, each of these things individually is not that big of a deal. But if you start adding them all up, it starts to get to be a bigger deal. And certainly my experience is you need to have someone who's responsible for taking care of this stuff. And they can have a day job, but somebody needs to be focused on it because it can be way too easy to ignore it, to let it fall through the cracks. And it gets worse the longer you ignore it. And it just sort of compounds on itself. And obviously, I'm an accountant, so I love accounting stuff, and most of this is accounting type stuff. And so it's real easy for me. But at the same time, I think, especially for really small organizations where you're all constantly running around with your hair on fire, running downhill with your arms pinwheeling, adding stuff to your list of things to do can seem like a lot. And so I think you really just have to be focused, determined, and take the time to carve out to make it somebody's baby so that it doesn't get ignored and forgotten and become a big problem.
Yes, definitely. No one likes getting that email a year later once you're about to move into your new building, the nastygram from your lender of you're out of compliance and we're missing all of these things. You want to focus on that ribbon cutting. So a few other tips for attracting that allocation. Borrower strength. Strength does not necessarily mean you're a huge organization. Strength means that you're organized, that you're prepared to take on this transaction, and that you have a true need for the equity and the subsidy that ultimately comes through the new markets financing. Which there's a little bit of a paradox of I can't get this project done unless I have the new markets tax credits, but I'm strong enough of an organization to support the debt. And you're just kind of dancing that line. Getting that financial house in order now and into the future, really having a strong understanding of your project, particularly regarding the community impact and being able to articulate that community impact, which, most nonprofits are, because you're living and breathing that mission. Development partners. What does an effective partnership look like in this structure? It's an architect, it's a general contractor, it's an owner's rep, really working with you so that you are prepared to respond to your lenders and investors in a way that is timely and works well with the financing structure. Um, Immerse your project into the industry. So Novogradac hosts 3 new markets tax credit conferences annually. We just had one in DC, and I think the next one is what, October in New
It
Orleans?
is.
So get down there, go hang out in the Big Easy and talk to CDEs and talk to them about your project. I would say it's infrequent that these project sponsors attend these things anymore, and you'll really stand out. And everyone's tired of talking to each other, so you might as well get yourself out there. And then get a solid consultant who understands your project, aligns with your values, and has real expertise. Anything else you'd add here for tips for attracting allocation, Nicolo? We've reached the end of our presentation.
I think when I think about attracting allocation, I usually focus on the elements in the application, all the promises that CDEs have made. And unfortunately, not all of those promises are created equal, right? And I have people come to me all the time and say, look, I've got this great deal that's generating great jobs and amazing community outcomes. And that's a great start. That's table stakes. That gets you into the dance. And now let's talk about what will separate you from everybody else who has those same amazing outcomes, but will help you to rise to the top because it is so competitive. And I think if there were a handful of things I would point to, and Sierra, I'm sure you have a few that are on your list. Hopefully, most of them overlap with mine. But I would start with being in an area of deep distress. The purple zone, I think, is a key. And that's new. It's relatively new. That's just from the last 1 or 2 rounds.
That's this round.
Yeah, the last round of application that we got this deep distress. Some people call it super distress. Sounds more distressed that way. And those areas are hard to find. And good projects, especially good projects at scale in those areas, are not easy to find, which is why those projects tend to be more attractive, tend to get more love. And as Sierra mentioned, many allocatees in this round have promised that they'll do 20, 30, 40. I think I even saw some applicants at 50% or more that they were promising they were going to be in these zones. And once they start promising that much, now they got to go out and find the deals, which is not easy. In addition, next on my list, I would probably say non-metro is another element. Sometimes when we say rural, but what we mean is non-metro, and there's a difference. It means you're not located in a metropolitan statistical area. Certainly, you could be rural under USDA definitions or other definitions, and yet still be within a metropolitan statistical area. So it's important that you identify that non-metro is really the criteria. And if you have both of those, then now we're really cooking, because that deal is incredibly more attractive by being able to stack both of those criteria. I would say a third element is, am I located in an identified state? And I don't think we've talked at all about identified states. We also sometimes call them underserved states. And an identified state is just that. It's a state. It's one of the 10 states that, based on the size of their low-income population in the state, they've gotten statistically the least amount of new markets love. And I think it's over the last 5 years. I think that's right.
I think so, yeah.
And the list does rotate a little. I feel like the states that are like number 8, 9, and 10 on the list, those states tend to rotate in and out off of the list every year or 2 or 3. And so on the margins, there are some changes on the list. I don't know that Wisconsin's ever been on the list, Sierra. Do you remember? Okay. Sierra,
I doubt it. Wisconsin has a lot of new markets action.
And as a result, you're punished. No good deed goes unpunished.
Yep.
You don't end up being on the list of identified states. But by golly, if you had all 3 of those things, that's what we call a golden unicorn, because those deals check all the boxes. And guess what? CDEs have made promises about doing deals that meet those set asides. And so if they can do one deal, that meets all of those set-asides all at the same time, that deal, I promise you, will get a tremendous amount of love. And by adding those elements, without any of those elements, a nice deal in an area of severe distress that has great outcomes, even with an amazing consultant like Sierra, your odds might be 30, 40%, I'd say, of finding allocation. You start stacking one of those items on, and now it's probably rising to 50, 60%. If you had all three of them, I would say you're in the high 90s in terms of your probability of finding allocation. Of course, assuming you check all the boxes for viability and sort of the bare minimum requirements to actually have a real deal and not just be a pretend deal that's aspirational. But if it's a real deal, then yes, with all those elements, you virtually have a lock on allocation, especially if you have an amazing consultant like Sierra, who's out there bird dogging the allocation for you. And not only that, but I would say that also tend to be those golden unicorn deals. They're the deals that tend to be able to get more allocation. So I've seen deals get as much as 50 million in allocation that are golden unicorn deals. Oh, one element I forgot to add, which is not you and it's never going to be you, but it's having non-real estate uses, which means that it's usually a manufacturing facility with lots of equipment and working capital. That is sort of the fourth prong to really be what's beyond a golden unicorn, a platinum unicorn maybe. And
we can structure those housing deals are often, you can kind of
maybe pick up
slip in under as that operating business.
And maybe get some non-real estate uses that way. But certainly I would say those are the criteria. I don't know, Sierra, if there's anything you'd add to that list.
No, I mean, I think it's important to understand that list. And as you can imagine, a lot of that's in control. If you're in Grand Forks, North Dakota, you're not really going to be able to go to a CDE and say, I have a wonderful project in rural Texas.
Because Texas is on the list of identified states.
It sure is, yeah. So, that's just it. It's just good to understand, and certainly there are lots of deals that get done that are not those golden unicorns. But it's always good to understand your stakes, I would say. And we have got 3 minutes left. I think there was maybe a few questions.
We covered a lot of
them. We covered a lot.
You did cover a lot. Thank you both for sharing your expertise. It's been a very informative introduction to NMTC so far. And I know you talked about this on your last slide, Nicolo. I think you've emphasized this quite a bit too, but just really want to underscore the importance of an organization entering an NMTC structure with its financial house in order. So you need to be able to respond to those lenders and investors timely, which is a direct result of whether you understand your financial house. So just understanding that and really want to highlight that as well. We had a couple of questions that I wanted to talk about. Someone asked, what determines and constitutes the highly distressed census tract? The Census Bureau, can it be changed or appealed? So Nicolo did point out it's based on ACS data. It can't be changed or appealed, but it is updated every 5 years. Do you all have some information on kind of some of those nuances of what make it deeply distressed versus highly distressed?
If you use that tool on Novogradac's website, it is you type in your address, and that is a great way to find out kind of where you are and what boxes you can check.
So deeply distressed includes areas like if you're on tribal trust lands, if you're in island areas, high out migration rural counties, and if you have 40% or more poverty, or you're below 40% of AMI. So those,
or your unemployment rate is more than 2.5 times the national
or the
average.
Unemployment rate being more than 2.5.
Yeah.
2.5.
My little cheat sheet to the right.
Oh, Sierra's got it right on the wall.
I'm cheating. It's I posted on the bulletin board.
Fantastic. Another question was, how can you find a CDE? Nicolo did put in the question and answer in the answered portion a link to find a database of winners. He did recommend that you focus on recent winners. The follow-up question to that is HCC a CDE?
HCC is not a CDE yet.
Yet.
Maybe one day.
Maybe one day, it's coming. Another question I just want to make sure we highlight, can you combine historic with LIHTC? You can combine HTCs, but you can't combine with LIHTC, although you can partition your property and do a side-by-side deal with LIHTC and NMTC. Nicolo, do you want to comment any further on that?
I mean, the idea is you could have a larger building. And for example, I've done several here in Portland. I want to say that Sierra and I maybe have worked on some deals where I've got a big building and maybe the top 10 floors are LIHTC units. And then the bottom 10 floors, maybe I've got a homeless shelter, maybe I've got some first floor retail, maybe I've got some office space for any number of organizations that are sort of local nonprofits providing services. And the top floors, I do LIHTC, and the bottom floors, I do new markets. They're totally separate entities. I've got either a lease or a condo map on the property to separate out those properties so there's totally separate ownership. But you can definitely do it that way. It's not technically twinning, but it's kind of sort of using them both on the same building.
All right. Thank you so much. And then we are being asked to drop the link to the map on the Novogradac site into the question and answer. So we will go ahead and do that while I am wrapping up here. Thank you, Sierra and Nicolo.
Do that.
This wraps up our question and answer portion. Thank you all for being participants in today's webinar. We hope the session provided useful strategies and lessons learned that you leave today with ideas you can apply in your own community. As a reminder, you'll find this recording and other educational resources on our resources webpage at hopecommunitycapital.com. Our fifth webinar in our 2026 series is coming up on Thursday, July 23rd. It is presented by our CEO, Carrie Sanders, on CDFI strategy. Registration will be open soon, so keep an eye out on LinkedIn and in our monthly newsletter for those details. That is everything that I have. Thanks,
and
everybody.
I just say, if you want more, you can go to my website, novoco.com. We have a 101 webinar. We have exit strategies. You can go get lots and lots of exciting resources there, including handbooks and monthly newsletters. So go to our website and find all the great content we have there. And then call Sierra, call me. We're here to help. Yes. We love your deals and would love to help make all your wildest dreams come true.
Perfect.
I will second all of the resources on Novogradac's website.
Yes.
They are excellent.
And not all of them even have me, so you don't have to listen to me all the time.
Oh, come on. All right.
All right. Thank you, everyone.
Thanks.
Ciao.